Energy was one of the strongest performing sectors in the S&P 500 this year. Not tech, not AI, energy, a major driver. A conflict that closed the Strait of Hormuz. That's the single most important choke point in global oil markets, and that sent crude prices to their highest level in years. And now, President Trump signed a deal with Iran. The Strait of Hormuz is reopening. Oil has already dropped roughly 20% from its 2026 highs. So here's the question. If you're invested in energy stocks, or if you're thinking about it, what does this deal actually change? And is the trade over? Or is this the moment most people get the thesis wrong? Okay, let's build the context really quickly because the sequence does matter here, guys. On February 28, 2026, the U.S. and Israeli military operations against Iran began. Within days, Iran moved to close the Strait of Hormuz. That's the narrow waterway through which approximately 20% of global petroleum consumption passes every single day. I've been there personally. Oil markets responded sharply. According to the EIA, Brent crude rose from around $61 a barrel in January to nearly $128 on April 2nd. That's the largest quarterly increase on an inflation-adjusted basis in data going back to 1988. Energy stocks, XOM, CVX, the XLE ETF posted significant gains in the first quarter alone. Then on June 14th, a ceasefire was agreed. On June 17th, the U.S. Iran signed a 14-point memorandum of understanding, opening a 60-day negotiation window toward a final deal. Key detail: the agreement included immediate U.S. Treasury waivers allowing buyers worldwide to purchase Iranian crude oil with no volume cap before a final deal is even reached. The market didn't wait. Oil dropped roughly 20% from its 26 peak within weeks. By late June, Brent was trading near $72 a barrel, back to pre-war levels. Here's where most coverage stops. At the headline. Now let's go one level deeper. Under the U.S. naval blockade, that dropped toward 2.85 million barrels by April, and Goldman Sachs estimated Iran had curtailed as much as 2.5 million barrels per day in peak disruption. With the waivers now in place, Iranian crude can begin flowing again, but the ramp up is not a switch. It takes weeks or months to restore full export logistics or to bring storage levels down and rebuild shipping routes. And the destination matters. Approximately 84% of Hormuz crude flows went to Asian markets in 2024. China alone was absorbing around 1.38 million barrels per day from Iran. And these flows are now competing with supply from the Gulf states and Russia that filled the gap during the conflict. Part of the market appears to be pricing in a faster resolution than the fundamentals may support. The reality is likely more gradual, and in that gap between expectation and execution is where the energy trade gets really interesting, guys. Energy stocks had an extraordinary run because of a specific event, and that was the Hormuz closure. That event is unwinding now. XOM was up 41% in Q1 26, CVX was up 36%, then the MOU was signed on June 17th, and both fell roughly 5% in a single session. The market was clear about what it thought the deal meant. But here's the nuance: the war premium. The extra price built into oil because of geopolitical risk is being removed. What remains is the structural story of energy demand. Global oil demand has not declined, guys. The Hormuz crisis created a demand-supply shock, and the resolution removes the shock, not the demand. Companies like Exxon and Chevron also have significant production in Guyana and the Permian Basin, assets that were not affected by the conflict and continue to generate cash. Two scenarios are worth tracking. If the deal holds and Iran returns fully, supply increases, oil normalizes in the $70 to $80 range, and energy stocks give back more of the war premium, but their underlying cash flows remain strong at these prices. If the 60-day talk collapse and the deal falls apart, then we go back to a supply disruption scenario and the energy trade revives very quickly. Geopolitics introduces the risk. Geopolitics remains central to the energy thesis. Most people look at energy stocks and they think oil price goes up, energy stocks go up, oil goes down, stocks go down. That's the first layer. The real edge is reading what drives the oil price before the price moves. And right now, there are three things to watch. Take note. First, the 60-day Memorandum of Understanding clock. The memorandum signed in June gives negotiators until roughly mid-August to reach a final deal. If talks stall, the ceasefire phrase, or Iran's hardliners push back on the terms, the risk premium comes back into oil very quickly. Second, OPEC plus response. Saudi Arabia and the Gulf states increase production to fill the Hormuz gap. If Iran's supply returns, OPEC plus faces a choice: absorb the oversupply or cut. and that decision will shape where oil settles structurally. Third, the companies that benefit regardless. Not every energy stock is a pure oil price bet. Pipeline operators, LNG exporters, and companies with diversified production geographies are less exposed to the Iran-specifically scenario. If you're building a position in energy, the distinction matters. The lesson of this year in energy is simple. Geopolitical events move energy markets faster and further than fundamental supply-demand shifts. Reading the geopolitics is reading the market before everyone else does. Energy was among the strongest performers in the market this year, not because of drilling technology or earning beats, it was because of a war, and now it's because of a deal. The investors who saw that coming weren't reading energy analyst reports, they were reading geopolitical signals and translating them into market positioning. That's the skill this market rewards right now, guys. Follow for more of this kind of breakdown. And if you want to understand how geopolitics moves markets across sectors, not just energy, that's exactly what we cover here.